Hi everybody, welcome to the last video of chapter 3. It's going to be an overview video of chapter 3. That way you can see what is everything putting together and in a short example. So I hope you enjoy this chapter and let me know if you have any question, okay? So I'm going to share the screen. That way we can see multiple things together. Okay, so I'm not gonna close this thing, and I'm not gonna do a presenting, you know, um, the presentation because it's gonna cover everything. Okay, so see draw. So this as you know, like this chapter is all about adjusting entries and closing entries. And a closing entry. Hence that we're gonna first talk about what is adjusting entry. So adjusting entry in the chapter 2, we know how to do the journal entry process, right? And then right now, what we wanted to know is what's the difference between the journal entry process and the adjusting entry process. Okay, the journal entry is focused on the external transactions, and then we're posting those external transactions to the general ledger, and then we are creating something called unadjusted trial balance, right? And however, the adjusting entry is to record changes in the asset and liability and their related revenue and expense account that have occurred during a period, but that we did not have recorded yet. So that means, sorry, I'm just gonna do the presentation, see whether this one works. Okay, so the adjusting entry means that we to record the changes in the asset and liability that during this period we have not yet recorded. Okay, so after that means that the journal entry process, the journal external transaction process is we can see and we record. Right? And then we're posting them in the general ledger, which is the T account, right? And then unadjusted balance. But the adjusting entries, we have to think about it. Because these things always happen in the end of the period when we wanted to close a book. Okay? Hence that this things that is gonna balance the book. Sometimes it doesn't balance. And this is because of what? Of the timing difference of cash recipients or outflow and the essence of the business transaction. Okay, and once we do record this entries, and we wanted to do the adjusted trial balance, right? And then, but still, it's incomplete. Okay, so let's look at what we talk about. We have a 4 scenario. The first scenario is that December 1st, the balance of a maintenance supplies account is about $400. And December 15th, the shop purchases additional $200 maintenance supplies with cash. Okay, and by the end of the December, we find that only 100 maintenance supplies remained. So that means that we needed to adjust, right? Something must happen. Okay, scenario 2. On December 4th, Mida received $6,000 cash from a local moving company in an agreement to provide truck maintenance services for $1,000 each month for next 6 months, beginning in December. Hence, on December 31st, 2020, which is when we close the book, right? The money that we received in advance was a liability. However, we might already performed 1 week performance already. Hence, portion of this $6,000 needed to be reduced, right? The liability should be reduced, and the adjusting entry is the revenue should increase just $1,000, right? Before I go inside the detail, we just go through this kind of question, see what really happened. And the scenario 3 is the mechanics have worked the final 4 days in the December, so and earned $600, but have not yet get paid yet. Midas plans to pay the mechanics on the January 2nd, but we are trying to close the book on December 31st, 2020. What that means that on this date, we still owe people salary, right? And this part of the salaries should become a part of a liability. At the same time, they also already worked, right? Hence that this is accrued expenses. Okay, scenario 4. Customer received 250 maintenance services from MEDA on December 29th and have not billed as of the end of the month. And the customer will be billed on January 3rd are expected to pay full amount owed by January 6th. Hence, therefore, December 31st, 2020, we have performed the services, but yet get paid. Hence that we have a revenue earned, but we have accounts receivable, right? Okay, so let's see. Adjusting entry in terms of prepayments involve cash flows occurring before the revenue and expenses are recognized. Very important. Prepayments is things that cash flow before, okay? Revenue and expenses are recognized. So there you go. In advance, we receive cash, right? And then if it's we pay the cash and then it's expense. Hence that in current period, which is December 31st, 2020, we know that we need to make an adjusting entry to decrease the asset that we actually accumulating because we prepaid those things and recognize it as expense. Okay, so let's see. So we prepaid $400 supplies on December 1st. We prepaid December 15th $200 expenses. And then at the end of the day, we go to the closet, we find out there's only 100 worth of the supplies. That means that how much we actually used? We used the 500 out of this 600 supplies, right? So therefore, in terms of external transaction, which is the chapter 2's learning objective, is to debit supplies for 200 during the period, right? And cash, because we paid cash for it, so that's why it's called a prepaid, right? Prepaid supply. And now on December 31st, we find out there's only 100 left, hence that we back out, there was a $500 was used during this period. And this used the portion of the supplies we consider is the supply expenses. Okay, so let's see revenue side, right? The timing differences between the cash received in advance and the economic transaction being recognized, no matter it's expenses and the revenues, considered recording decreased asset or decreased liability and recognize expenses or recognize revenue during that period, current period, right? For example, we received $6,000 for service, right? Service maintenance revenue, cash for the future revenue. So hence that we defer those revenue and consider it's a liability because we haven't performed our duty yet. So in terms of December 4th transactions, we consider this deferred revenue of $6,000. And then during the December, due to the time elapsed, we did perform our services. Hence, we earned 1/6 of this $6,000 prepay. Therefore, we reduce the liability account and we increase the revenue account for $1,000, right? Okay, so, and then there's another way of looking at the transaction is that in current period, there is revenue, there's expenses happened, but we haven't received we have not paid the cash related to the expense yet. Or there is revenue, for example, let's look at this for salaries payable exactly as this scenario. So for example, by December 31st, we know final 4 days in December occurs about $600 salary expenses, but we're not going to pay those people until January 2nd. So on December 31st, we're automatically generating a liability, which is called a salary payable for $600, and we record our salary expenses for the current period because those services was done during the current period. Hence, by the next period, which is next year on January 2nd, even only 2 days difference. This is a new accounting cycle, okay? And we will come to pay those payable, which will reduce the payable and credit cash, okay? Okay, on the other hand, the accrued revenue means that we have provided services in current period. That means we were increasing our assets for account to be received and we will recognize revenues. And when the time elapses, when the time that we did receive cash, we will reduce the receivables and we increase in cash, right? For example, on December 29th, there's a 250 maintenance services has been provided, okay? And customer will be billed on the next period in the future. And then the month will be received on January 6th. So therefore, on December 31st, since we have already performed our services, we automatically increase our asset account called accounts receivable for the things that we have already performed, right, for $250. At the same time, we recognize this revenue because all our legal obligation for earning that piece of revenue has been performed. Hence, that we do need to record $250 as revenue for current period. And the next period, which is involving the external transaction, is that when customer did pay us on January 6th, therefore, we reduce our accounts receivable and we increase in cash, right? So the net impact on the asset account of this journal entry is 0, right? Because both are asset account, one asset decreasing, another asset increasing. Okay, closing entry. What is closing entry? Closing entry is to prepare the temporary account for the new accounting cycle. In other words, we want to zero out temporary account. Okay, and what are the temporary accounts? There are revenue, there are expenses, and there's a dividends. And all the relationship is RE. We want to dump every balance back to return earning. Okay, this is how closing entry is all about. So as you can see, adjusted trial balance, meaning that after we posting all the closing entries, we have a cash, and we have payables, we have equities, we have return earnings, a dividend, right? All this is on the balance sheet. And all this service revenue, salaries, expenses, and this is on the income statement, okay? So preparing closing entry and posting the closing entry to the return earning T account. Okay. So first of all, asset has equals liability plus stockholder equity plus return earning. And these two components is stock equity statement. And income statement, all we need to do is find the revenue minus expenses, and minus expenses. Hence, that is 43,000 minus 3,600. And then we got 700 net income. And the net income is very important portion of return earning. Okay. Hence, that 700 gonna move to the return earning account. And after the adjusted balance, let's say this is what it would look like before, right? And then what happened is the return earning account has a 1,700 balance in the beginning. So it's a beginning, right? And you have an income, which is a revenue for 4,300, and you have a total of 3,600 for the cost expense. And also you paid dividend for 200. Hence the ending balance of return earnings 2,200. And we will look how do we closing all these accounts, right? We said we want to dump everything out of revenue by debiting revenue and credit a return earning. We want to dump everything of the expenses account by credit all the expenses and debiting return earning. We want to dump all dividend amount out and then by crediting that dividend by debiting return earning, because so revenue is a credit account, right? Revenue has credit balance. Expenses has debit expenses on normally, and dividend has debit expenses. So clear this number out, we need what? We need to debit it out, credit out expenses, credit out dividend, or to the return earning account, right? Okay. So this one goes to this side, and all these two go to the left hand side. Okay. So what happened is that after the adjusted posting the closing entry, look what happened. Everything disappeared. All the temporary account disappeared. Am I right? All the dividend disappeared, revenue disappeared, and expense disappeared. Only have balanced balance sheet account, which is cash, asset, liability, equity account, right? Okay. So, okay, this is a rework on the return earning balances. Why is that 2,200? Because beginning balance is 1,700 plus net income is 700 minus 200 of dividend. We get 2,200 of return earning, right? So this is what happened is called the post-closing trial balances. It has to equal, left has to equal to right. Okay, so summarize. Adjusting entry is to adjusting things during the period that we haven't recorded. And then once we're adjusting those prepaid expense, pre-received revenue, which is called deferred revenue, or accrued expenses, unpaid expenses, or we didn't get paid the revenue, which called accounts receivables, all those things that we supposed to record but we haven't yet. And then we have adjusted trial balance sheet. And in adjusted trial balance sheet, what we want to do is trying to creating the closing entry. The closing entry is helping us to make sure that we close out the temporary account. Once we closing the temporary account, which is service revenue and expenses and dividend, we were left with a balance sheet account that we can check whether left side equals right hand side. And then therefore we got our most accurate or final balance sheets. Okay. So this is wrapping up the first 3 chapters that give you a very big overview of what happened to accounting cycle, accounting measurement, accounting communication, right? So we will have an exam right after this chapter, hence that this is very important 3 chapter to set up the foundation correctly. I know it's a little bit a lot of more information, but I know you guys gonna get it. So I see you guys in the class. Bye.